We've got we're live. We're back. I was getting into that song. I don't know if everybody else likes that
No,
song at all. That was
it up.
better. It sounded like Another One Bites the Dust there for a little bit, which kind of makes sense given why we're doing this and what's been happening around the globe. But everybody, thank you so much for joining the Carson Investment Research team. I'm Ryan Dietrich, Chief Market Strategist. We're going to introduce ourselves with the titles here in a second. We woke up this morning and realized there's a lot of things going on. And there's a lot of people out there giving opinions. And we said we want to get together, our team get together and do a live stream and let as many people out there watch this. Obviously, this will be recorded. So if you're watching the recording of this, but we're excited to be here. Probably going to shoot for probably 45 minutes to an hour, I guess. Just talk about how we see the world. Let's see who I'm going to start with. How about we'll start with the guy who's the furthest away. That would be Sonu. Sonu, your title and where in the world are you?
Yeah, Vice President, Global Macro Strategist, Sonu Varghese. Yeah, no, it's hard to think of where I am. No, I'm in London, across the pond, as they say. It's I wish I could say fun to join you guys, but it is fun to join you guys, so I'll keep it at that.
You said you got out of packing. Your wife is doing the packing right now, so thank her for joining us. Barry over in Boston. How we doing, Barry?
Great. VP Asset Allocation Strategist, Barry Gilbert. And great to be joining everyone today.
And then Grant from the home office. Go ahead, Grant.
Yep, holding it down here in Omaha. Grant Engelbart, VP Investment Strategist.
There we go. So again, we'll start a lot of different ways here. Well, not a lot of ways. We're gonna start one way, but a lot to talk about. I mean, we won't share the slides yet. Chelsea's our producer helps us a ton getting all this stuff live, so don't share that yet. But let's just start high level. You think about everything that's happened. It feels like there's multiple things that have kind of been the domino effect. We've had weak economic data. We've got the Fed that's out there. And now, I hate to say black swan event, but what's going on with Japan? I mean, I think, Grant, I'll start with you. That's all right. I mean, talk to me about Japan, because that's the one that I think, everyone, the Fed's behind the eight ball, economic slowing. And all of a sudden, we're all becoming yen carry trade experts. What's going on over there?
Yeah, the yen has historically been one of the lowest yielding currencies out there, which means it's one of the best currencies to borrow money in. Warren Buffett has kind of famously done that in recent years. Mm-hmm. So that's part of this carry trade where you borrow money in yen and then you invest that in higher yielding currencies. Well, the Japanese, central bank took interest rates positive for, I think, the first time in 15 years recently, which kind of spurred this, deleveraging unwind of the carry trade, as well as just overall speculative positions worldwide. That kind of started last week, carried over the weekend. We saw it hit risk assets over the weekend. Yeah. We see cryptocurrency prices trade 24/7 now, so we can kind of get a sentiment gauge even when futures aren't open. And so that was one major contributing factor, but it's really there's a number of different things going on at the same time that I think are all kind of compounding on each other.
So look, we've got that. So Chelsea, let's go ahead and share the screen now. So Barry, the Fed, there we go. Yeah, perfect. That's the slide we wanted. The Fed on Wednesday said no cut, but left the door wide open for cuts to take place in September. Market rallied. I mean, it feels like a lifetime ago, but the market rallied on that. But then quickly we got the economic data. I'll ask Sonu about the economic data in a second, but just from the Fed point of view, it just feels like they're behind the eight ball now with some of the things that have happened just since Wednesday. You want to talk about that?
Yeah, just not quite enough. When we got the meeting minutes, or not the minutes, when we got the statement, looked like it was maybe a little bit hawkish. That got corrected a little bit when we had the press conference. But we're at a place now where inflation is really last year's story. The economy is still growing, but the growth is slowing at this point. And doesn't really need a boost, but doesn't really need the Fed keeping its foot on the brakes at this point. And with the most recent data that we got, with the numbers that we got on the jobs, it's really starting to look like the Fed should actually be supporting the economy right now. There's not a real reason to stay this tight.
Well said. I mean, Sonu, you're the Fed whisperer to a degree as well. You've been saying for a while on our Facts versus Feelings podcast, the Fed could cut. We thought they could have cut last week, maybe even 6 weeks ago. Okay, so whatever. We can say that all we want. Is the Fed, if they do a 50 basis points in September, is that going to be a big enough eraser for not cutting soon enough, or what's that mean?
Yes, I mean, short answer, yes. I mean, they should have ideally they could have cut in June, right? Yeah. I think they were spooked by a lot of people, not just them. Not to just blame it on them. A lot of people were spooked by the Q1 inflation data. And you remember, even 6 weeks ago, 8 weeks ago, people were talking, before we got the last CPI report, everyone was
Right.
talking about stagflation and, maybe we need rate hikes from here. Come on. Right? What are you even talking about? Interest rate hikes when inflation's falling, and all these forward-looking indicators of inflation, right? Whether you look at consumer expectations of inflation, that's more or less only a tick or two above where it was before the pandemic. Business expectations of inflation are back to where it was before the pandemic. Market expectations of inflation are back to where they were before. Need I go on, right? And then actual inflation, which by the way is backward looking anyway,
Yeah.
right? But all these forward looking stuff, and then we got wage growth data as well. That's not scary. So I don't know what the Fed was looking at. They were spooked, and even in the press conference, Powell sort of juggled with the idea that we may not cut, for the rest of the year. That's a possibility. Come on, I mean, what are we? Don't drive by looking at the rearview mirror. We know that about markets. Same thing with economic data, right? I think as someone said it, yes, it's good to be data dependent, but don't be data point dependent.
Hmm. I like that. You think about the Fed again. There's been times it feels like they have to get beat over the head before they finally decide to make a change. I mean, some of this feels a little bit like late 2018. Right? I remember late 2018, the market threw a fit, if you will. Yields dropped significantly, almost pushing the Fed's hand to say, "Listen, you need to turn more dovish here." And then they did soon in 2019, and that kind of off to the races. There were a couple of rate cuts in 2019.
And by the way, even in
Go ahead.
1995, going back all the way to 1995, I was just putting, I think I shared this on Twitter a little while ago. Greenspan had to be, yes, he cut in 95. Now the narrative is like he cut based on, yes, productivity growth, all of that. He looks like, from that perspective, very wise to have done that, surgical cuts. But he had to be sort of pulled kicking and screaming into the rate cut path, right? May 1995 payrolls fell about 62,000. June payrolls are up just 8,000. This is June of 1995, right? What happened after that? They cut in July. Over the full year, payrolls averaged about 145,000. This was back in 1995. Again, all that data got revised. Now we look at 1995. Payrolls averaged about 100 and close to 190,000. By the way, 1995, guess what the unemployment rate was? 5.8%. In fact, from April to May, it rose from 5.4 to 5.8%. So like I said, maybe the Fed needs a growth scare to get them kicking and screaming into rate cuts.
That sounds like where we are. Barry, let's talk about those jobs number. The jobs number on Friday came in 114,000, expected between 175, 180. Unemployment rate, and I want to talk about the SOM indicator also, went up to 4.3%, higher than expected. What'd you think, though? Because when we looked at it, it just felt like there were some wonky things taking place. How worried were you when you saw that number Friday?
Part of it was the surprise. There are one-off factors in there as well. One number just isn't enough. So I was a little bit surprised that the market reacted as strongly as it did to the number. Unemployment rate increasing is a concern. But if you look underneath the data at what's going on, the real key is that we're really not seeing an increase in layoffs. And that's where the danger is, because that's the point where you actually start seeing payroll start coming down. That means less spending. And that's what puts the economy at risk. So it was not a good number. But there were some mitigating factors, make it surprising that the market responded as strongly as it did. But as you said earlier, this is about different things combining. Right? So we had the Fed story from earlier in the week, then we had this number, and then the final piece today with what happened with the yen in Japan.
Yeah, I mean, just so people know, and you probably do by the time you listen to this, Japan on, I guess, let's see, Monday morning for us, was down 12.4%. That's the Nikkei, the 220 Nikkei, down 225 was down 12.4%. Second worst day ever for Japan, and worst two-day return in the history of the Japanese stock market. At least looks like going back to 1965. And again, that's because the carry trade, like we talked about. One interesting thing I found, we did have some rough weather last month. And when you look at that, thanks to the hurricane that went through Texas, there were 1.3 million households and businesses that still had no electricity in the great state of Texas a week after that that hurricane went through. And according to the BLS, 461,000 people did not go to their job last month because of weather. We saw a huge spike in temporary jobs that were lost. We saw, let's see here, 250,000. Another 250,000 said they couldn't work for quote unquote other reasons. Maybe because it's summertime, they didn't feel like working. But Sonu, I mean, you talked about this before, and that 461 people who didn't work because of weather, the average July back to 1976 was 41,000. So it's 10 times more than what you normally see in July. The Fed, not the Fed, wrong place. The BLS, Bureau of Labor Statistics, said itself that they didn't think weather played a role in this. You kind of have a little take on that. What do you think?
Yeah, and I think when they mentioned weather didn't play a role in it, I think they're more talking about weather not playing a role in response rates.
Whether or
Right.
not. I see how you did that, Sonu. I see how you did that. Nicely done.
So pun intended, or maybe not.
There you
But
go.
no, I think one thing to keep in mind to get into the a little bit of a deep dive into payrolls, we have two surveys, right? The 114,000 payroll jobs gained, that's from the establishment survey. The numbers you were citing, temporary layoffs, things like that, that's from the household survey, which is where the unemployment rate comes from, right? So it's not, it's not easy, and you shouldn't probably mix both of them. You can take some sort of average or gain some sort of insight from one versus the other, and that's how you should read these things, right? But the other side of it is, I'll put it this way, the rising unemployment rate is never a good thing, right? Because it usually has some momentum of its own. If it's going up, it more or less tends to continue going up. If it goes down, it more or less tends to continue going down. But we've talked before about the employment population ratio, which is kind of the opposite of the unemployment rate. Our unemployment rate can be, you know, affected by things like that, who's classified as being unemployed, right? They have to be actively looking for work. Then there's labor force participation issues, demographic issues, all sorts of things, right? Whereas the employment population ratio is just how many people are working as a percentage of the working age population. And you look at prime age workers to get around the fact of demographics, that we are an aging society, that hit 80.9%. That's the highest we've been in 2 decades, since 2001. So now, could that fall off a cliff? Sure, right? But the fact that it went up, it didn't go down, I was like, okay, that's a positive, right? Yep. I still think this should be, quote unquote, scary enough for the Fed to cut maybe 50 basis points. But in terms of an actual, should we really worry about the economy? I'll put it this way, maybe a probability of a recession is maybe about 20, 25%, something like that. I don't think it's anywhere close to 50%. I don't think it's a base case, but I think it's maybe closer, about 20%.
No, well said there. I see we've got over 1,200 people, looks like, joining us on the live stream right now, which is awesome. So thank you for taking some time with the Carson Investment Research team. Feels like we talked about bad news. Grant, I want to pull you in. Let's talk about something good. I mean, earnings overall, at least according to FactSet, looks like 11.5% expected here in the second quarter. It was like 8.9% just a couple months ago. That'll be the best year-over-year quarterly growth since, I believe, late 21. You're kind of the earnings guru. What stood out to you, good or bad, from this earnings season so far?
Yeah, we're getting close to, last week was a huge week for earnings, obviously overshadowed in a lot of ways by what happened macro-wise and later in the week, but we're getting close to, 3/4 of the S&P reported. And things look good. Almost 80% of companies have beat their expectations. Positive.
So, Chelsea, you can go ahead and remove the slides for now. We'll just show our faces. Thank you, Chelsea. Go ahead. Sorry. Go ahead, Grant.
Yeah, no, good. For the most part, you mentioned that growth number is great. These are all historical numbers. Obviously, the market's a forward-looking mechanism, so we're taking that with a grain of salt. But still, the numbers are strong, and there's a momentum to earnings as well. What someone said with unemployment rate and other things that have this upper momentum, it's also difficult for companies to earnings to drop off a cliff all of a sudden for the most part. So that's positive. We are seeing some areas that we've highlighted before that are not. The expectations continue to get higher and higher and higher. Obviously, NVIDIA being the poster child for that. Yeah. And there's pieces of those, bits and pieces of those earnings report where the numbers may have not been as stellar as the market wanted to see. and hope to see. You see like companies like Intel doing kind of a full revamp of their business in some fashion, at least their workforce. So there's a few, as always, standout results to the downside, but for the most part, we're seeing these aggregate numbers look strong, and we're seeing other areas of the market that we haven't paid as much attention to that aren't AI related.
Yeah.
Seeing that breadth expand from an earnings perspective, which I think is positive. And we talked about all these different things that were happening at the same time. The AI trade and the thoughts that it might be overdone is another contributing factor to this, right?
Sure.
You get earnings reports from Microsoft and others that show certain elements of weakness, and then over the weekend, Buffett kind of comes out with that the Berkshire Hathaway has cut the stake in Apple, and it just contributes to the sentiment and kind of that snowball effect of negativity that was out there. So I think as the market sifts through this and we finish out earnings season, we're still going to see positive numbers that I think can help provide the lift and a longer term perspective.
Yeah, I mean, forward 12-month earnings up to what, 263, I believe, almost 264, which is obviously a lot higher than it was at 224 at the start of 23. Not a recommendation at all, but there's that MAGS MAGS ETF, which is the MAGS 7. They kind of lump them together and made it an ETF, and it was up well over 100%. Okay, until just recently, starting in about 15, 16 months, give or take, when it started trading back in early 23. So again, these are companies making a lot of money. These are solid companies. We're not saying anything against that. But when you look at some of those moves, that is an awfully stretched rubber band. Barry, here at Carson Group, we have close to 500 financial advisors all across the United States. We're in 42 states. We're $37.2 billion total AUM. You and I were on a call for a while this morning. And Joe Sonu actually joined us from across pond as well. We had an extended morning call. It's just another example of things that we are doing to reach out to our advisors, help them in times of needs and times of stress like this. And one of the things is that SOM indicator. I don't want to get too wonky with this, but we hear about it on TV. The SOM indicator, the SOM rule, it triggered and a recession is imminent or near, or maybe we're in one. What did you see when you look into the SOM rule here, and what is it, I guess?
Yeah, economist Claudia Sahm, when she was doing some research, I think for Brookings a while ago, developed this rule. Pretty straightforward, which is part of what makes it attractive. It's not a deep econometric, sophisticated thing, but that's part of the reason why it's very usable. We knew this was coming, so we actually were writing about it a couple of weeks ago, just to get out in front of it. And the idea is when the unemployment rate comes up a certain amount, and you can look up exactly what the calculations are, then historically, if you get that right amount, you've been in the early stages of a recession. Forget how far back it goes that it's actually worked, and it has very few false positives. Yeah. So it's been effective, but you can read what Claudia Sahm has written about it, or you can hear what she has to say about it because she's done a podcast.
Just turn on TV. She's on. I think we love Claudia. She's on TV all the time anymore, especially right now. Yeah.
And she had written a blog at some point called something like "I've Created a Monster." That she recognizes this is not the way to do economics. The SOM indicator served a specific function with a margin of error. It's worthwhile to start providing fiscal support when you get it, because maybe you were early in a recession and it's been a pretty good indicator. But people have really run with it. They've examined the numbers to the tiniest bit. So
yes.
Usually we round the unemployment rate to the nearest 10th, but if you do the math and you stretch it out so it's not to the nearest 10th, and you do the calculation, well, then we didn't actually violate the SAM rule. But on the other hand, if you do it to the 10th, you did. Any indicator, and this is a good indicator if you interpret it right, but any indicator that flips from an on to an off signal, depending on whether or not you round, is probably not a very robust indicator. So take it as a warning. I think something that Dr. Sahm recognizes, that we all recognize, is the economy is in a funny state right now.
Yeah.
Post-pandemic, during the pandemic, we had all kinds of extremes: monetary policy extremes, fiscal policy extremes, people's work habits changed. Then there were all these adjustments in response to that, and everything just got all twisted around. Numbers that have worked historically haven't been working. I mean, that's something that Sonu was advocating for a while, with everybody looking at the LEI and the inverted yield curve and the ISMs, and all the different things that people were looking at, completely missed the context. of where we actually are right now. So the SOM rule does tell us something. It's real. It tells us that risk is higher because the unemployment rate is going up. But I wouldn't take it to mean that we've crossed some bright line that means we're absolutely in a recession right now, and apparently nobody knows it.
You know, one other thing you said this morning, Barry, and I'm going to paraphrase it, and you're going to give me the exact numbers. You looked at, like, I believe it was a bunch of ETFs, right? Like 50 ETFs, and you found that the Japanese hedged ETF was like one of the best performers and least volatile. You want to take it from there? Because clearly that's not the case anymore.
Yeah, we know there's always a risk with when a trade gets extremely crowded. And so I was looking at I follow probably about 400, 500 different ETFs, and I was looking at 5-year track record as of the end of June. So out of these, that list, there were about 300 ETFs.
Okay.
Had them all ranked out. And of those 300 ETFs, the hedged Japan ETF had the 5th best performance, which is pretty extraordinary. The only things ahead of it, a couple of semiconductor ETFs, a couple of tech ETFs.
Yeah.
But the volatility on that was much lower than all those other ones. So it easily had the best Sharpe ratio of them. And it just shows how crowded, how popular that trade had actually become. And hardly even noticed, but people were running into it. Sonny, you and I had a conversation about that particular ETF some time ago. And
for a while now.
The way it stuck out from us. And you need to watch out for those huge extremes.
And just goes to show, like, the Japanese Nikkei, since the Bank of Japan's decision last Wednesday, the Nikkei is down 20%.
3 days, right? 3 days, I believe. Mm-hmm.
Yeah. Since Wednesday, right? Since they made the decision. So depending on how you count the time, like how many of our 24 hours that Japan is, all that. Yeah, they're down 20%. But it also gets, in addition to the carry trade, the weak Japanese yen has been good for Japanese companies too, right? Because a lot of companies in the Japanese index a lot of them tend to be exporters, right? For one thing, Japanese consumers don't buy a lot of stuff. So Japanese consumers make money by selling to the rest of the world. A weak yen is very advantageous for them. And suddenly things have flipped. Suddenly the yen's gone from 160 to the dollar down to 140, or it's flipped, but up to 147, right? Like somewhere between 5-10% in a few days. That's huge. That's a big move. If it happened over the course of a long time, I think it would be fine. But this is where somebody's asking, like, what is grossing down, right? Because so many people had to deleverage. Everyone had to gross down positions. What does that mean? You're borrowing in yen, to Grant's point earlier. You're leveraging up. And if you have to cut down, what do you cut down? You cut down the positions that have gone up, whether it's Apple or whether it's a Mag 7, where more recently maybe small caps. I'm just looking at my screen here. What's one thing interesting is actually somebody on Twitter just commented to us on the stream. The Brazilian real is going up, the Mexican peso is going up. That's not risk off, right? I mean, emerging market currencies don't go up in a risk off environment, or unless something's changed. But like we say, this time, it's truly not that different. I mean, if this is truly risk off, I think emerging markets could be getting hit. The dollar would be getting bid. We're not seeing any of that.
No, I love that concept of the dollar being bid up, because you pointed this out also, that listen, in 22, when stocks and bonds had like their worst year ever combined, the dollar was historically strong the first 10 months. Think back to March of 2020, right? Gold was killed, bonds were killed, stocks were killed. Look it up, right? When COVID started, everything was going down except the US dollar. In times of stress and fear, the dollar gets that bid. It's that safety net. It's a cleanest shirt, a dirty laundry, whatever you want to call it. And we're not seeing that this time. So again, what are the four most dangerous words? This time is different. Well, listen, is this a pure risk-off moment, or is it deleveraging with all the drama that's happening in Japan? Maybe it's some of that. Believe me, it's reverberating around the world. There's no question about it. But at the same time, everybody, listen, when Tony and I talk about this all the time on Facts versus Feelings, you see, 3.4, 5% mild pullbacks a year. You see 3% pullbacks a year. On average, you see a 10% correction a year. Doesn't mean every year has to have these, but this is the second 5% correction. We, as of the time we're recording this, have not had a 10% correction. Who knows? By the time you listen to it, we might be there. But I think it's important to put context around that. Now, one thing, Grant, I want to bring you in because I think it's interesting. Let's talk cryptocurrencies. We're kind of probably somewhat limited how we can talk about them. Just broadly speaking, though, they're very liquid, right? They trade 24 hours. You can push a few buttons on your phone, get that money out. They crashed, obviously, recently. Is that just a function of when there's margin calls and there's volatility, people just getting their money back? Or what's your take on kind of the sell off in cryptos the last, well, I mean, I guess call it last 24 hours?
Yeah, it's a good point. I think there's definitely liquidity there in Bitcoin in particular, and you've had a run, you've had money flow in via the ETFs. So there's probably, part of that trade is related to what we're talking about with AI and technology. Then you have this beta on top of Bitcoin. So you have Ethereum, and then on down the list of things that are realistically higher beta than Bitcoin. You're probably going to sell those first if you own them. There's so many people that own Bitcoin that there's going to be liquidation there. And you're really seeing that. You're seeing some of these coins down 20% a day on down the list as people are looking places to take gains. A lot of these cryptocurrencies are up in the still 50+% year to date, even with some of the drawdowns. So you're looking across your portfolio and taking gains where you can.
Is that the downside of institutional, Grant? Is that the downside of institutional engagement for crypto in a way? I mean, it's hard to get hard numbers with this stuff, but like, why should the Bank of Japan's decision affect crypto? Crypto is supposed to be non-correlated retail, but then
Right.
wait a minute, it's down 18% in a few days, and so I'm curious.
I think actually, like institutional adoption of the most likely, we've seen like the University of Wisconsin add one of the Bitcoin ETFs to their endowment portfolio and others. I think with that kind of long-term idea and concept, that it should help stabilize that market a little bit, right? You have real money, that's not fast money, that's sitting in the product for longer term, and we've seen those steady inflows. But at a certain point, the inflows got pretty large, and that unwind can happen quick. And I think that's the point of all this, right? Markets move quick, especially in summer Fridays. The yen, a lot of CTAs were short yen going into what's happened here with the reversal and the strength in the yen, and so that has to be unwound, that has to be covered, and that compounds itself and does so really quickly, like we saw overnight.
Yeah, speaking of really quickly, I mean, the VIX volatility gauge, the fear index, was up over 50 today. You look at in history, I mean, up over 50 is like GFC and COVID times. I mean, that is pretty rare. So again, I'm going to say only, got my air quotes out here, S&P is not even down, not even down 10% yet. So it's just kind of amazing.
Down 6% since the Bank of Japan's decision, by the way, 6%.
Now, other parts are down more, and small caps have obviously been hit. But hey, small caps, they had the historic run. So, Chelsea, go ahead and share the screen. I think I've got the chart. Perfect. There we go. So let's talk about the JOLTS a little bit, Barry. The Jobs Opening Labor Turnover Survey. Did I say that right, guys? I just call it JOLTS. It's once a month. I forget about the next day. But the bottom line, we're not seeing much movement in the labor market. Like hires are low, but layoffs are low and quits are low. What all does that mean to you, Barry?
I think one key thing it means is just normalization. We see things coming down quite quickly, but they went up quite quickly. So trying to find a new balance rather than just potentially having momentum and shooting off in a down direction. Probably the most important line on this one is I don't know what you call it, teal. The very bottom one. The very bottom one is layoffs, because that's really the key point. And if you look at where layoffs are as a percent of total workers.
Yeah, as a percent of the workforce. Yeah, employed workforce.
To scale it appropriately. And layoffs are still at very, very low levels.
Yeah.
And unless we, if we're starting to make a checklist of things to watch where we would become more worried, seeing those layoffs pick up would be among them. But we're just not seeing it right now. Just staying at a very low level.
Yeah, exactly. The layoff rate is 0.9%. So layoffs as a percentage of the employed workforce. Before the pandemic, it was running 1.2, 1.3%. Right. So the unemployment rate is not going up because people who have jobs are being let go. It's rising because new entrants and re-entrants into the labor force are having a hard time finding a job. And that gets to the second line here. Forget the yellow line. The hiring rate is, job opening rate is what it is, right? That number it's Ryan, you and I have talked about, who knows how exactly that's being measured, right? But the hiring rate is real. That's come down a lot. It's been hard to find a job, right? That's a reality of the job market. But look at 2021 and 2022, it went up a lot. I think firms hired a lot of people and they're pulling back. I mean, there's a reason why productivity, I think, is rising too. Firms have invested a lot in training the workers they hired in 2021 and 2022. and now we're getting the fruits of that, right? And going back to Barry's point about recession, and everyone wants a smoking gun indicator, right? This is what I like to call like indicator macro, like,
Mhm.
oh yeah, PMIs or yield curve or the SOM rule, and suddenly it's like these things that may have been statistical regularities, oh, suddenly it's failed, or maybe we just have to wait, or whatever it is, or maybe it's a yield curve disinversion now, right, that leads to a recession as opposed to yield curve inversion. But you look at a totality of the data. Today we got data from the senior loan officers survey.
Right.
Commercial industrial loans, they're going up. Real estate loans, they're going up. Consumer loans going up. Tightening lending standards are easing. It's not completely easy, but it's easier than it was 3 months ago, 6 months ago. So there is that story as well. I mean, look at all of it.
So you're saying there's some good news out there, Sonu. I like it. Well, we've got maybe 15 minutes or so. Going to take a break for a second here. I went to the Cincinnati Reds game on Friday and saw a no hitter. It was not the Cincinnati Reds that threw one. The Reds were no hit. But you think about how many baseball games you go to, and it was funny because at the end of the game, we were rooting for the no hitter. Like whatever, like the Reds are going to lose. It didn't matter. By the eighth inning, the place by the last out, people were cheering against the Reds. Which kind of feels bad to say, but whatever. It's what it was. Sonu, what's been the favorite thing you've done over in Europe so far? You've been there for what, a week or so? How long you been there? What'd you guys like?
About 10 days now. It's
okay.
I think the highlight was honestly the Alps.
Mm-hmm.
Right, the Alps, and second favorite is I got to go to Stonehenge. Stonehenge is quite binary because my kids are like, what's the big deal? It's a bunch of stones, right? But for me, it's like, maybe you guys will appreciate this. I know you guys like history and all of that. Well, it's like prehistoric, and just thinking about how it is put together, and it's a cool thing to see. It was hard. The kids are like, what are we doing here? Like, but the Alps were really cool to see. I mean, we got up to the top of Europe, Mount Jungfrau in Switzerland, so that was fun. The kids enjoyed that one though. It was cooler, I should say. So weather has a lot to do with it. I know all of you have kids, and older kids than I do too. So
we have our own version here in Nebraska called Car Hinge. If you ever get the opportunity, it's literally Stonehenge with cars. But,
interesting.
So to your point on the smoking gun indicator, I think that was the yield curve, right? It was infallible, or it only didn't work once, and we've been inverted now for 2 years, and so it's time to move on to another indicator. And the SOM rule is that choice. Now you can't dismiss either one of those, of course. There's definitely implications that we should be considering, but at the same time, that's how the financial news flow works. But I think what you said there, what's happened in the last 2 or 3 days. Yes, we've seen sell-offs. We've also seen significant easing of financial conditions in a certain way, right? From an interest rate perspective, from a prospective interest rate perspective with what the Fed's going to do. So I think that is the good news there, is that there is room. There's the ability to unleash housing activity with lower rates. That's already coming up in discussions all over the place. So there is a positive to the decline from a financial conditions perspective, although it doesn't feel great at the moment.
No, I have a question for you guys. This has been on my mind, looking at now markets are pricing in about more than 100 to 125 basis points of cuts this year, maybe 75 to 85 basis points of cuts by November. At least to a 50 basis point cut is like completely baked in for September, and some probability of a 75 basis point cut, right? Maybe there's some inter-emergency thing. How do you think, does the Fed talk this down now, or what happens? I'm curious. I'm trying to think through it myself.
Well, we do have Jackson Hole coming up later this month, right? Obviously, we'll all be staring at that. That's are you going to Jackson Hole this year, Sonu? Did you get your tickets or no?
I don't think I can.
Every year we joke that you need to go. They need to let you talk. They listen to you is what they need to do. But yeah, there's all the different Fed members, and I think they're going to start talking it. I mean, Goolsby was on. Barry, did you see what Goolsby said today? Goolsby, Chicago. I know that much. What do you have to say?
Yeah, he kind of said, "Calm down, everyone."
Yeah, exactly.
It's that we've got the economy's back.
There's just one number.
Right.
Yeah.
I think part of what they want to do right now is they want to normalize 50 basis points in case they want to use it as an option without panicking people. So that's the aim right now. Traditionally, a 50 basis point cut is a panic cut. I think this is a situation where it really doesn't need to be a panic cut. But they need to communicate around that to have the market absorb it in that way. It doesn't mean they're going to cut 50 points, but it means that they need to give themselves the option, and that's going to take a little bit of talking.
Did Greenspan cut rates in '87 after the crash? I'm trying to think of how big of a financial shock. I mean, from an economic perspective, to Goolsby's point. I mean, yes. I mean, there's no, I think, reason to panic cut and like, oh, emergency meeting, we're going to cut because we got only 114,000 jobs last month and 4.3% unemployment. No, they don't have to do an emergency meeting. But if there's a financial shock, liquidity crisis, which is like what could potentially happen, right? If this carries on for 2, 3, 4 days more. I'm curious, Ryan. I know you know that history, or any of you. Did the Fed cut in '87 after the crash?
I am pulling up my data, so feel free. Someone else talk about.
Sorry if I threw that out.
I'm going to get it here.
Like, see, we're not prepared for it. We're just chatting it. But I'm curious if they cut, because at some level of like, and we've seen that during COVID. There's a financial. Oh, they wanted to stem the crisis with treasuries, things like that. They opened so many facilities. We saw the same thing in 2008. You could argue maybe 2019 with the repo crisis as well. They did that. I'm curious, at some level, I think, this could be a financial shock that could affect or impact the economy in an adverse way, and so we need to cut. Right, but I'm trying to think at what level that is. I don't think a 6% drop in the S&P 500 is it, by the way.
I don't think they would ever do it just because of the markets. I think it has to be what's making the markets actually drop. Now, they can play around with that a little bit with their communication, and they can really be doing it because of the markets, but they can make up a story about what's behind the scenes. But I think they need to see a threat that they viewed as more systematic in order to be able to jump in and do that.
No, I think that makes sense. I mean, maybe the BOJ will come back and cut rates by 25 basis points, and then we can all go back to the yen carry trade graph. I was chuckling about that, but
yeah, I mean, just a level set.
All right. Asking you shall receive. 87. So this is Bloomberg data. Now, those take note. They did not, they being the Fed, no one knew they did cuts or hikes until, like, I don't know, the next 2 days or something, like 2 and 3 days. Maybe you saw it in Wall Street Journal when you looked at some short-term rates. But they did a hike. Oh, this is interesting. April Fool's Day. They did a hike on April Fool's Day to 7.75, a 25 basis point hike. Another hike to 8% in May of 87. Another hike of 25 basis points middle of May. And another hike in September. And one more hike in October 7th. 1987. So the Fed was aggressively hiking, I think we'd say. Then they cut 25 basis points on October 22nd, right after, obviously, the crash. Another 25 basis point cut November of 87. Then they didn't cut again until February of 88. So there were a couple cuts, but that's interesting. They were quite hawkish, I guess we could say. 87, even though stocks were up 40%. Eventually, Camel's back was broken. But yeah, there you go.
Real time, Q&A answered. Grant, sorry, you were saying.
No, that's good stuff, and I think that's an important point, right? One of the tools that the Fed has at its disposal has, there's a 5.25% ability to cut rates, if you will. So there, if there aren't excesses in the economy, which we don't really see a ton of those, the biggest issue right now is tight financial conditions and the labor market. And in terms of what the Fed can do, they have a large bazooka ready to go and able to cut. They probably should have, obviously, last week, but now they can spend this next month and a half talking that down through various Fed speak prior to Jackson Hole happening, and we'll see where we're at. Just a level set too, where we're at. Came in under 9% from all-time highs today on the S&P, so came back a little bit, almost got to 10, not quite, and then the Nasdaq's down about 15 from all-time highs, and that decline started well before what happened over the weekend. But just to kind of level set with where we're at, we're still above the 200-day moving average on the S&P, and the Qs actually dipped below it, but then have kind of rebounded back above the 200, which is an important, obviously, line in the sand to watch there.
So we've got about 10 minutes probably or so of this special aftermarket call live stream with the Carson Investment Research team. I want to thank everyone on the marketing team and compliance, I guess, who helped us get this through. It's not easy to wake up one morning and see global markets crashing and say, hey, you know what we need to do? We need to do a live stream today and get the deck approved today. And Sonu, oh, by the way, he's across the way, and all the stuff that's going on. So hopefully a lot of people appreciate this. I know it's not fun, it's not easy, but it's something we absolutely love to do to help our financial advisors, help our Carson partners, to give feedback and honest feedback and critiques where it's necessary. And there's a lot of it going on today. Sonu, one thing that's positive is productivity. We've had it on the screen here for a little bit, probably touch on it. You've been of the opinion that higher productivity is kind of that magic elixir that's necessary for a better economy, for better GDP growth. Some of the best years ever to the relative to what was expected were years with better productivity. Looking at you last year with 6% nominal GDP growth because productivity is strong. And it just came in last week, very strong again in the second quarter. You want to talk about that for a minute?
Yeah, this is the other side of, in addition to all those things I mentioned in terms of forward-looking indicators for inflation. Yes, the productivity data we see on this page here is very backward-looking. Don't use it as, leading indicator or even a coincident indicator, but it tells you something about what's happened in the economy, and that's certainly useful. And this is where it's been frustrating that the Fed has not sort of, especially in Q1, right, into April and May, they didn't buy into the fact that inflation is actually easing, despite wage growth is running strong. It's not, I think red hot relative to where we were before the pandemic. But we were seeing disinflation. The signs were there. Why? Because productivity, right?
Mhm.
Productivity plus inflation is wage growth. Plus, you could argue margin growth as well. So some of those productivity gains, companies don't pass it all into wage growth. They take some of it themselves into margin expansion too, and we're seeing margins expand at the same time, right? But I think that's the other side. The whole key is we have tight labor markets. Going back to
Yep.
the employment population ratio, 80.9%. That should tell you we are in a positive labor market. And we talked about the quit rate being low as well. Workers have been at their jobs for quite a lot of time now, at about a year, 2 years. We're not seeing a lot of churn in the labor market. One of my favorite economists, a labor market economist, Guy Berger,
Yep.
said, this is like everyone talked about the great resignation a couple of years back, but this is really the great stay, right? People are staying in their jobs, but they're presumably becoming more productive at your jobs, right? I think everyone talks about AI and that whole story boosting productivity. I think that's further down the line, assuming that happens. We're positive on that, I think, safe to say. But that's not what's driving productivity growth right now. Right now, it's a tight labor market driving productivity growth, which is another reason why the Fed should be careful about breaking the labor market, or I should say, not breaking the labor market. I mean, Barry, you and I have talked about this ad nauseum. I mean, we've had several good conversations about this, and you know, like I said, goes back to the Fed. I mean, the Fed has every reason to protect this labor market.
Barry, do you want to add anything there?
No, I know we're almost done, and
Yeah.
I'm just going to give a shout out to Bonds, not Bobby or Barry, but good old fashioned Bonds. I know they're boring. People don't like to talk about them, and I'm not a bond guy. I'm more bond adjacent or bond curious or something like that. But they under these particular circumstances, they've actually provided diversification. I looked at all of the sell-offs that we've had since the pandemic, and really the best place to be if you wanted any kind of stability was just cash or short-term treasuries. This is the first case where, at least for a few days, bonds are back and they've done their job well.
Yeah, I mean,
and one reason to have a diversified portfolio, right?
Yes, because we were told 60-40 was dead after 2022, and it felt that way, but we always pushed back against that. And Sonu, you and I have talked about on the Facts versus Feelings podcast, we actually added some treasuries for the first time. Gee, well, at this point, guys, almost probably 10 weeks ago, give or take, probably a while ago. And fortunately, that's playing out. I love this quote, just as we kind of wind things down, from John Bogle. He famously once said, "The stock market is a giant distraction from the business of investing." You think about that. How many distractions have we had? I mean, just last Wednesday, we're like a stone's throw away from all-time highs. The market liked what the Fed had to say, and everything is kind of turned on its side. Now, I know some people are going to listen to this so you can't see it, but we are sharing on the screen now. The historically, stocks tend to go higher amongst bad news, and this goes back to 1900. There's been a lot bad things that have happened since 1900. Yet the Dow, was up over, well, not anymore 40,000, but up over 40,000, 41,000 just a couple days ago. Today, actually, the Dow did drop 1,000 points. It reminded me of the August 24th or 26th of 2015. That was the first day ever the Dow fell 1,000 points. Now, clearly on a percentage basis, that was a much bigger deal than what happened today, although today wasn't fun either. And that happened when China devalued their currency. I don't even know if people even remember that or not. It's like, oh, well, the first 1,000 point drop, why'd it happen? I remember it because I was like unemployed, had major back issues. I'm in a doctor's office, unemployed, and I can barely walk. And the Dow's down 1,000 points. So I'm like, God, this is about as bad as it gets, But anyway, here we are 9 years later, doing a little bit better, talking with you guys, having fun in the midst of what's not really all that fun. Let's do final things. Grant, any final words of wisdom from the home office in Omaha from Grant Engelbart?
Yeah, I think actually you brought up the 2015 yuan devaluation. I think there's a lot of similarities to that. A lot of the action happened overnight. It caught markets by surprise, contributed to this unwind, but we recovered pretty well. After that,
yes, we did.
A couple days later into the future. So I think that's a great thing to bring up there. Continue to watch markets are reacting quickly in directionally negative over the last couple of days, but that can easily just as easily snap back the other way. And as we talk about missing the worst days, those best days are right near those worst days almost all the time. Mm-hmm. So you want to make sure you're on the right side of history from that perspective.
I'll just add, Barry, go to you next. I'll just add this. Usually the best days and worst days all take place beneath the 200-day moving average. Not surprising because you're stretched. That can work both ways, most volatility, which is unique because we are not beneath the 200-day right now as of the time we're doing it. Still a ways away, actually, which is a good reminder. We were so far stretched above that 200-day this time just a few weeks ago that maybe some volatility made sense. Barry, what do you want to end with?
Still thinking about bonds, but I'm going to expand it out a little bit more to diversification.
You like bonds more than you can admit. You talked about it twice now, Barry. Come on now.
This is me talking about not talking about bonds.
There you go.
I think one of the things we've seen the last few days, we know this is true, but we keep forgetting, is that markets move fast. So when it comes to diversification, I think oftentimes people say, well, I'll put it in there when I need it. I'll just be able to respond to what's going on. The people who can actually do that effectively are few and far between. So thinking about in these types of situations, good portfolio construction, having not a diversifier like bonds, but potentially having multiple diversifiers. Yeah, bonds have just done their job and we can celebrate that, but they've done their job very poorly for most of the last year. And there are other kinds of diversifiers that have been very effective. It's been an interesting year for gold. So portfolio construction and diversification, it's really about being ahead of the curve and not trying to be right all the time. Because when you need those diversifiers, you need them fast and faster than most people can actually move.
Mm-hmm. Yeah, well said. Sonu, how about you?
I think that portfolio diversification is key. I mean, just looking at, again, since the BOJ decision on 31st of July, S&P is down about 6.1%. Mid-cap stocks are down under 6%. It's still down. That's still a lot, but it's done relatively slightly better than the large cap core index, the S&P 500, right? So more diversify your portfolios, right? Don't be concentrated, and even within the equity side of your portfolio, right? Yes, diversify equities with all these other diversifiers that you have there, including bonds, managed futures, things like that, which is what we've done in our portfolios as well. But even within the equity side, you want to diversify and not be stretched into any one side of the market, as phenomenal as a story may sound, right? Whatever that story is, right? Not to pick on any single story. So yes, and then I'll just wrap up by saying, looking ahead, right? What am I looking at? Obviously, what the thing on my mind is, how does the Fed try to talk the market away from a 50 basis point cut in September, or because I as of Thursday, I don't think they were ready to do 50 basis points cut in September, right? So the question is, do they get to where the market is, or do they start to try and talk the market down from that, right? And do we see that probability of a 50 basis point cut, I should say, go from 100% down to, say, 50 to 40 to 30 by the time we get to September, right? Week before September. And so Jackson Hole will be key as well. And then in terms of the economy, I think mortgage applications, right? The most cyclical part of the economy geared to interest rates. And one way how monetary policy works, I think, or maybe the key way how monetary policy works is through housing. Does housing activity pick up? And the first thing you can see there is mortgage applications, right? So far, it's been kind of disappointing how rates have come down and mortgage applications haven't gone up over the last month. But I think there's some instability in rates. I think we may have to see mortgage rates go below 6.5, maybe closer to 6%. I think hopefully we see some activity, and that could boost, GDP growth, right? Remember last quarter, residential investment was a drag on GDP. I mean, not a massive drag, but still a drag. So we'll see what happens in July, August, and September when we get the data.
Yeah, and the good news is we'll be here and we will be talking about it. I consistently looked. We had well over 1,000 people every time I was looking on today's special aftermarket volatility update with the Carson Investment Research team. So thank you for so many people who joined us. There's a lot of places you can get your news, obviously, but a lot of people obviously trust what we're doing. I've always said we're not always going to be right. We're not always going to be wrong, but we're going to be very, very transparent. If you're a broker dealer, if you're an advisor out there, just how'd your broker dealer help you? How'd your research shop help you today? We're doing special calls. We've got client letters. We've got multiple blogs coming out. We had an extended morning call this morning. What else are we doing, Barry? There's something else we're doing. What am I forgetting? There's more in there. I don't know. I'm sure there's more.
You're doing a chart book. You've been putting it together all day, right? I know that's going into a blog, and you mentioned that, but
chart book, an extended blog.
Right.
I mean, yes, there's lots of different ways.
CarsonGroup.com/research, everyone.
There you go. CarsonGroup.com/research is our blog, and we've got lots of cool things there. I mean, just today, I've heard probably 6 to 7 times people from a past life at a past shop asking what our team is thinking, right? I mean, that tells you something. They don't care what the current shop thinks. They care what our team is. They're not even there. I mean, that tells you something. So that's a big honor, and it's something that we don't take very lightly. We like to have fun with what we're doing on our team, but believe me, we are stewards of assets. We work very hard and take it very, very seriously. When things like this happen, it is unfortunate because it scares a lot of people. A lot of people make bad decisions at the worst possible time, but hopefully what we've done here and we're going to continue to do on our team is Bert White, who's hired all of us, or hire all of us? No, not quite. He's hired 3 of us at least, but Bert always said in times of stress and fear to over communicate, even if you don't know. Who really knows how bad this yen carry trade is going to get? I don't think anybody does, but we're going to be there every single day talking about what we see and how we see it. And that's how I think Carson's built differently, but specifically our investment research team. So if any of that sounds appealing to you and you're a financial advisor and you want to come to the good guys, check us out. Come on over, carsongroup.com. We'd love to talk a little bit more. So with all that, everybody, thank you again for joining us. Let's hope we have some green tomorrow. I don't know if we can say hope. It's not a guarantee. It's just hoping, right? Let's get some green. But all in all, the economy's still strong. There's still some positive things out there. Doesn't feel like it, but we're going to get through this just like we've gotten through all these other very, very scary times throughout history. So thank you again to Grant, Barry, and Sonu for joining us. Thank you to everyone out there who's listening to this live stream live. A huge thanks to Chelsea specifically, who's helped us get this through, but also to Sam and Joey on the marketing team who helped a lot guiding us through a very, very busy day of content creation behind the scenes that you don't quite see, but it's all coming out very soon. So take care, everyone. Enjoy your Monday. We'll see you very soon. Thank you.